Okay. Hello, everyone, and welcome to Stablecoins Are Killing It, episode number 14. I'm your host, Lou Kerner, with Just Stable. We're a stablecoin media company. In addition to this show, at juststable.com, you'll find the first Web3 messaging board specifically devoted to stablecoins. So we've got a great show for you today on episode number 14, featuring the founders of Ampleforth and an esteemed advisor of them. I'd like to welcome our guests, Evan Kuo. Evan?
Hey guys, great to be here, and I'm happy to kind of share what we're up to. First, a quick disclosure.
Let me also just introduce the other panelists, Evan. Brandon Iles,
oh, sorry.
The other co-founder of Ampleforth. Hey, Brandon.
Yeah, happy to be here.
And we also have an esteemed advisor of Ampleforth, Manny Ricon-Cruz, who's also with the Hoover Institution. Thanks for joining us.
No problem.
And then we have a co-host today coming from UK. Hey, Ganesh.
Hi. Yes, I'm joining Lou as a co-host, and yeah, so I'm a researcher on stablecoins at Warwick Business School.
Oh wow.
Yeah. So, Ganesh, he's been a guest on the show and has probably attended more of the shows than anybody, and he's obviously an expert. So I'm happy to have him join as a co-host. We're going to start the show. Evan and Brandon are going to walk through a presentation that's going to be followed with a fireside chat between the five of us up here. And then we'll spend the last 20 minutes or so with questions from the audience. If you have a question, please put it into the chat box on Zoom. And if we pick your question, we'll let you know and we'll tell you where you are in the lineup. And then we will bring you up as a panelist so you can ask the questions yourself with your video and audio on. And with that, I'd like to turn it over to the Ampleforth team.
All right, guys, I'm going to just really quickly walk through what it is the Ampleforth protocol does. Full disclosure, it's actually not a stable coin. So I understand that there's a lot of stablecoin research and discussion going on here. It has qualities that are not unlike a stablecoin, but it doesn't have the same intended purpose at all. I'm going to go ahead and share my screen, and I will walk you through a very short presentation.
And this is nice. I guess this was a presentation that you just recently gave to one of your investors.
It is. It was a short 5-minute presentation that we did for Pantera. But what Ample is it's actually an adaptive base money. So what do we mean by a base money? Well, like Bitcoin, it's uncollateralized. So it's not like Tether or MakerDAO in that it's redeemable for some other asset. It's totally uncollateralized. But unlike Bitcoin, it has an automatic supply policy that responds to price exchange rate. And so in this sense, it's kind of like this commodity money, right, that can react to the marketplace. It's not a bank in that it doesn't maintain any notion of credit or debt. It only maintains what it is that you own and allows you to transfer between peers. So the interesting thing about the Ampleforth protocol is it's capable of increasing or decreasing the quantity of Ample tokens in user wallets without any transfer between peers and without any sort of bank. And the manner in which this happens is both automatic and non-dilutive. So basically, it looks at a price exchange rate, looks at the volume weighted average price from the previous day. And the protocol basically can increase the quantity of Ample tokens in wallet balances proportionally, or decrease the quantity of Ample tokens in wallet balances proportionally based on price exchange rate. So in other words, it's using this price exchange rate as a proxy for answering the question of whether there's more demand than supply or less demand than supply. When there's more demand than supply, we increase supply directly to users. And when there's less demand than supply, we decrease supply directly from users. And all of these supply adjustments are applied universally and proportionally across wallets. Now, real quick, I'd like to get into the motivation behind the design of the system, because it really is quite different from the motivation for why you might design a stablecoin. Now, most people might create a stablecoin because they need something to store value in that's not volatile, something to use as kind of a trading pair, exchange-based trading pair token like Tether. Maybe it would be designed for payments, but Ample was actually designed to address the limitation of fixed supply assets like gold and therefore Bitcoin. And really, there isn't a whole lot wrong with gold. Gold is a pretty good money, and so is Bitcoin. You only run into issues with it if you start to construct a banking system on top of it. Basically, it runs into issues like potential deflationary spiral when you start to think of it as a building block for a financial ecosystem. But as on its own, it's kind of just this fixed supply asset that can be used as a store of value. What we did in the case of Ample was we introduced this elastic supply policy to address it. But upon further analysis, working with Manny and others, we kind of hypothesized that Ample might have a lower correlation with ETH and BTC than today's digital assets, because this supply policy, the manner in which it increases or decreases supply, actually affects your return profile as an investor. If you're holding Amples, you might gain because the Ample price goes up, but you might also gain because you get more tokens. And the dual nature of this kind of affects the movement pattern of the coin altogether. So we suppose that it might actually have a low correlation to existing digital assets, which are themselves hyper-correlated today. And two kind of important things could follow if this were true, right? It means that Ample could add value to baskets of digital assets by reducing aggregate volatility. So you see this happening in portfolio construction, where people want to decrease the correlation of assets that they hold in a basket. But you also see it, done programmatically. We have smart contracts that hold baskets of assets as collateral, and adding diversity to those baskets of assets actually reduces risk of things like auto liquidation. It reduces aggregate volatility. And the second thing that follows from this is Ample could be a useful building block in the broader decentralized finance ecosystem. Because it has this price target, it can be used actually for contract denomination. And so, one of the difficult things with, things like debt, when you have a floating price token, is like, say you and I want to enter into a bet. Say it's something like, if the Warriors make it to the playoffs, I'll pay you 100 ETH. I might not want to enter a contract like that because I don't know what the liability of 100 ETH is going to be if the price of ETH itself fluctuates. And because the Ample has a cyclical price target, can actually be used for contract denomination without introducing any sort of traditional asset or collateral. And so as a follow-up, the Ample has been live for just over a year. We actually kind of did a correlation study along with Gauntlet research that showed that it is in fact, uncorrelated with BTC and ETH. And this is something we can talk about a little bit more. We recently went through kind of a transformative period of growth. So in the last couple of months, like particularly in July, we launched a program called the Geyser, which is a liquidity mining program that allows people to stake these liquidity tokens like Uniswap Ample ETH pair tokens to receive a continuous drip of Ample from the Eco Fund. And that kind of has bootstrapped a great deal of growth. So that's the basics of what Ample is. And I'm happy to jump into a quick Q&A.
Okay, thanks for going through that, Evan. So yeah, I'll start off the fireside chat here, and Ganesh, obviously, feel free to chime in. But so, can you talk about how Ample has evolved since you came up with the original idea, both up until when you launched, and then you've been live for years, so I'm sure you've learned a lot from the launch, since you've been live.
Yeah, totally. I mean, originally we had this design for an asset that, it actually had this algorithmic reserve. It had a bank, so it would automatically expand and put some of the expansion proceeds into a reserve that would be used to buy back assets, because the idea was to attempt to create an algorithmic stable coin. Then after running a bunch of simulations, we realized that it would never truly be fault tolerant unless the collateral asset that was held in the reserve was in fact itself a stable coin, or something much like the dollar. So at the end of the day, in order for it to be truly fault tolerant, it would have to be something a lot like Tether. Otherwise, it would be this system that relies on kind of a free market, debt marketplace to kind of maintain stability, which eventually would run into a liquidity crisis. And I remember talking to Manny early on and showing him the design of that system, and he wasn't super thrilled with it. Manny, maybe you can tell the story from your perspective.
Yeah, I think so. Evan and I met over dinner, I think, a couple of years ago, and we just started riffing on macroeconomics, and then he explained the system to me. And to me, it's the history of pegs is usually a history that doesn't end very well. They're expensive to maintain and defend, and especially for a project that was launching in a much smaller space, right? In crypto, that would have presented, a large space of vulnerability, I think. So. Yeah.
Manny, just real quick, what's your research background in?
So I'm a financial historian by training. My area of specialty is Chinese financial history, but I also do a lot of network research. And right now I'm at the Hoover Institution at Stanford University, where I organize the history working group. So we have a conference, a seminar series, a working paper series. So that's kind of what I do there.
The broad history or history of finance, money?
History of finance, yeah. So this was right up my alley. You can see why we became fast friends. So yeah.
And when you heard it, what did what did you use as an analogy for it?
So I think the original design to me was very much like a traditional like currency board, or a sort of the standard central bank design from the Bretton Woods era, right, where you basically have a set of reserves to defend a peg. And the reason that I'm still sort of very skeptical of those designs in crypto is that a state does in fact have a way of getting reserves, right, which is a trade surplus. So there is a way of shoring up your reserves to maintain a peg indefinitely, but in an algorithmic design, it's in fact kind of a much cleaner closed loop. So for me, that wasn't necessarily how you would want to do it. But then, I think Evan and Brandon, they reached back out. We kept talking, but they eventually did change the design and it removed the reserve aspect, which made it much more robust.
Yeah, not just more robust, but I think potentially more interesting to the opportunity that's fundamentally being presented by crypto, right? Because we already have banks. We have discretionary banks. We have banks that can defend pegs, right, by printing money, by bailing itself out through trade surpluses. What was really novel about Bitcoin is it was able to bootstrap this nominal exchange value from nowhere, right? For the first time, it was able to create a commodity money, essentially, or a synthetic commodity money, without any direct connection to any previous system. So it's like we've always been able to create banks, right? Creating a bank might be something that the Medicis would be proud of you for having done. It's a very kind of manly achievement. But creating a commodity money is kind of a godly achievement. Like Isaac Newton would have been impressed. He was like famously obsessed with alchemy, trying to create gold, right? So the ability to create a commodity money that's not unlike gold in a purely digital context was a huge breakthrough on the part of Bitcoin. And so it kind of speaks to the real opportunity here, which is to create new uncollateralized monies. And so when we kind of got rid of this bank, right? So we got rid of the reserve, we took away the balance sheet, and we reached back out to Manny, and suddenly he was just like, okay, this is really interesting, right? And this is in contrast starkly to the rest of the technology community. I think everybody was leaning on trying to recreate the Federal Reserve, or directionally trying to recreate the dollar on the blockchain. How do we take this kind of central bank system and decentralize it, right? Whereas it was really apparent, just from talking to folks like Neil and Manny, that like, hey, I think the juice here is the opportunity to create new commodity monies, new uncollateralized monies that have no connection to traditional finance. And so when we took away the reserve, it became apparent that what was left, the Ample that you know today, with a very simple non-collateralized supply policy, was a unique commodity money. And not just one that's arbitrarily different, but one that has supply elasticity, which speaks to the only problem that natural commodity monies like gold and silver ever faced, right? And so I think it's important to kind of think about it in that context. Like, okay, well, we are now able to recreate a digital gold. The Bitcoin protocol has succeeded that. Well, what are the limitations of gold and therefore digital gold? Well, a fixed supply asset. runs into problems when you start to use it as a building block in part of a banking ecosystem, just like we saw under Bretton Woods. And so how might one solve that problem? Well, the building block would have to be supply elastic. And that's directly what, the Ample achieved. It wasn't trying to go, from like, how do we create digital gold to how do we create a digital commodity that can replace all of central banks? It was trying to go from like, okay, we've seen that a digital gold can be created, right? How can we create a new precious metal that could be a cornerstone of a new financial ecosystem, that's much more robust, and that's what the Ample is. But as kind of this added benefit, we also observe that it will just move differently in the marketplace, not just from today's digital assets, but from all assets. We've never seen an asset with a supply policy like this that directly increases or decreases to wallets. And we kind of hypothesized that it would have this distinct and very specific movement pattern that might allow it to decouple from today's digital assets. And that's kind of a big deal too, because like, the fact that Bitcoin is so random on top of being non-dilutive is actually what makes it interesting from a portfolio construction perspective. And for that same reason, the Ample might also be interesting. And so it was kind of the insight of Manny to kind of draw upon, I think, two pieces of research as we kind of put forth the Ample white paper. The first one was Selgin's synthetic commodity money, which kind of examined these digital currencies from the perspective of base monies and monetary economic theory, and kind of laid out what needed to exist in order for a new kind of financial standard to be created on top of these digital assets. The other paper was kind of Lou and Savinsky's risk and returns of cryptocurrency rewards, which had kind of examined the risk exposure of Bitcoin to, precious metals, commodities, equities, and so on and so forth. And, the conclusion of the Selgin paper was, well, could you create, a synthetic commodity money with a perfectly elastic supply? Because if so, that would be fantastic, right? And the conclusion of the Lou and Savinsky paper was, well, given that Bitcoin doesn't really have a great deal of risk exposure to these traditional assets and it's non-dilutive, we recommend that you buy or hold a certain percent of your portfolio in Bitcoin, right? And just combining those two things, it's like, cool, let's architect a new base money that addresses the issue of, fixed supply in the spirit of Selgin. And oh, by the way, it turns out like it'll move differently, and so it has a position and a role to play inside a portfolio. That's kind of how we got to Ample today.
Cool. Ganesh, did you want to? You got a question, or yeah, I've got a lot. Your microphone's off. You're muted.
Yeah, so I just have some slides to share. Is it fine if I quickly go through them?
Sure, if you think they're additive to what Evan walked through.
Oh, wow.
Okay, so I don't want to obviously take too much time, because I'm basically just want to present just a little discussion of what I think are some things in Ampleforth's design that I wanted to ask as a question. So I should just preface this, that this is completely my views. Lou has kindly invited me to share this, and I'd be obviously, as the creators of Ampleforth, be very interested to hear your feedback. So obviously, when I read on Ampleforth, I found that obviously being an algorithmic cryptocurrency is really great, and this avoids sort of the problems that Tether and others have faced, which you've already discussed. Avoiding the inflation tax by being non-dilutive and being really transparent. So these are the things that I think are really good about Ampleforth. The only thing that I guess wanted to ask a bit more about was thinking more about stability. And I know that you view Ampleforth as a bit different to stablecoins, but if we think about the target, the half-lives are quite large, and particularly for discounts. So when there are periods where you trade at a discount to one, the sort of convergence back to one takes a much longer period of time, and that's what the half-life measures. And so I guess the potential sort of solutions that I've been thinking about are changing the parameters in the rule. So on the top, we have the sort of formula of Ampleforth, which is obviously a very clear formula, very easy to follow. But a couple of alternatives are to increase the eta term, which is increasing the elasticity parameter, and that essentially will sort of be more aggressive when prices deviate from the target. And the second alternative is a more elasticity type rule. And so naturally, this alternative has the problem where if the price goes really low, then you can get a really large percent change in the quantity. And that could obviously be sort of unwanted, in terms of reducing supply too drastically. But essentially, these are the three rules graphically displayed. So the blue line is the current rule. And essentially, the alternative one is just making that line steeper. So if you're more aggressive at changing supply when the price deviates from target, and the green line is an elasticity rule, and essentially, I mean, it's been trimmed off here, but if the price goes very close to zero, then that percent change will get very negative. But obviously, this is more of a thought experiment. So I was very curious to get your thoughts on this.
Yeah, I'm happy to provide some really kind of, quick initial thoughts. Like, I think too many people make the mistake of assuming that the goal is actually stability, because there is a price target, right? But I mean, really, that's it's more of a means than an end. The target tells us whether there's more demand than supply or less demand than supply. And it empowers the protocol to systematically increase or decrease supply in response to demand. And if you'll recall, that's actually the problem with fixed supply assets. That was the problem of gold. It wasn't the problem of gold that it was unstable. The problem of gold was that it was inelastic, right? So we had to cancel redeemability under Bretton Woods for fear of a deflationary spiral. And that's because as the demand for gold increased, people were kind of tending to hoard gold. They believed that their nugget of gold might buy one thing today and two of that same thing tomorrow. And as a result, the circulating supply of gold started to decrease and decrease in a situation where we were obligated to allow people to redeem dollars for gold, or at least not people, central banks and foreign governments. That was the risk of deflationary spiral, and that was the problem of natural commodity monies. And so the price target is actually more of a means than an end. And you kind of see that reflected in the design. Like you said, there is that rebase reaction lag parameter where we do divide, the quantity theory supply that should be changed on any given day by 10, right? If the goal were so overtly stability, then perhaps we wouldn't have smoothed it in such a way. And we also do only rebase once a day, right? We do so based on the 24-hour volume weighted average of the previous day. So there's smoothing on top of smoothing. And I think what's being kind of expressed in that design is just that, the fact that, the price target is a means, not an end. And this is what I mean by this is very different from a stable coin. It's very natural to assume that the goal is to be stable, but kind of what I was trying to say earlier is the goal is to build a better base money. Really just something that's more robust as a building block for a future financial ecosystem. And so the other thing I guess I would add that we didn't anticipate at the time of the white paper is the effect of AMM platforms like Uniswap. So really, on Uniswap, the quantity theory of money is real, right? You change supply and that reflects itself in price instantaneously. But on traditional order book exchanges with matching engines, it's not real. And so it does have that effect where like it might very well be the case if you were an asset that was only on Uniswap and you did want to perfectly offset price constantly, you could rebase really fast. But that would only work in these kind of systems where there isn't really any sort of price discovery going on, and the bonding curves are kind of arbitrarily defined. But I think the broader point, yeah, is that, you know, the stability is not the goal.
Yeah, I was going to add on that a little bit. I do see the price target as basically it's kind of a barometer for, you know, excess demand or a lack of demand. And I think the thing that is being adjusted, which is actually important, though sometimes people don't think too much about it, is actually the supply. So I tend to think of this in the same way that, you know, you might think about damming up a river, right? If the price target is kind of like the dam, if you have excess demand, you kind of build up your supply in this kind of reservoir behind a dam. And if there's a lack of demand, you slowly kind of start losing some of that demand and shrinking the reservoir. But it's really the outstanding number of amples that actually has some relevance. I mean, there's a particular type of anchoring, right? If the total circulating supply is, you know, 200 million amples versus, you know, 100 million, people tend to hold on to them because they think, well, you know, I have twice as many as I had before, and the current supply number in some ways is kind of an amalgamation of information about previous demand, right, throughout the history of the protocol, right? Because the current supply is in fact a reflection of the history of the demand for it. Yeah, I would say that that's kind of, I think, the key variable that's being moved there, which is slightly different than the exchange rate, which is totally crazy a lot of the time.
But just to kind of as my last question, have you considered changing either the frequency of adjustment, so going from once a day to once an hour of rebasing? Or have you ever considered altering the formula, like in periods when you're far off from the target?
Of course, yeah. We certainly have considered that. In fact, like that chart you showed, that we did go through a long period of contraction. That was largely due to the fact that, like, we had initialized that reaction lag to a very high value. It was like dividing it by 30. And then sometime in November, we changed that to 10, and it came back to its target much more quickly. But I think the point that might be missed here is that, imagine, this is the analogy that I often use to help people see this. It's like, imagine that a new generation of precious metals is being created in the form of these digital assets, right? That's what these are. Let's just call cryptocurrencies a new generation of precious metals. And then now imagine there's this new system of rudimentary banks and clearinghouses being created that are decentralized. And they're trading and storing these new precious metals, right? The base money is the precious metal, and the banking system kind of executes transactions on top of the precious metal. And it's more like, what sort of base money would be better, right? As opposed to, how do we make something stable, right? So I think about it like, maybe a more direct analogy that people can relate to is the MakerDAO system, right? The MakerDAO system, its output is DAI. That's a stable coin, right? Its purpose is to remain stable at $1 because it fulfills all the use cases of a stable coin. It can be used as a base trading pair on exchanges. It can be used for payments. It can be used to kind of service the unbanked. But the base money that was collateralized by MakerDAO was ETH and basic attention token. And our question is to ask what properties of these base monies would make for better building blocks for this new financial ecosystems, the output of which might be something like DAI, but might be other things. And it so happened that on Black Thursday, with Maker being what it is, and with the digital assets being as correlated as they were, that sharp correction causes the system to kind of face a liquidity crisis and fail altogether because it was hyper correlated. Our question really is to ask, like, how do we build a better building block? Because I think that's more direct than how do we, create something that's constantly stable. And for that matter, we actually do have assets that are very stable. The US dollar is very stable, right? And Tether, a collateralized form of the US dollar, is also very stable. So, we're looking to do something different from the perspective of portfolio. There's no necessary place for things like die.
Yeah. If I could elaborate on that. So there is kind of a historical precedent for thinking about this, right? If you think about just the properties of gold itself, the chemical properties of gold have not changed in the history of the world, as far as we know. But you can build different types of currency on top of it, right? You could have gold coinage, which has certain positive, sort of properties and also certain drawbacks. But even if you're thinking about, say, dollars or sterling issued under the framework of the gold standard, there is a whole layer of institutions that mediate between the actual sort of base money itself, which is gold, and then the actual currency that's produced, right? You have a commercial banking sector. At some point, you add a central bank that's interfaced through, a system of reserves and that, management of the interest rates. You then sort of monetize debt on top of that. And so there's this whole sort of layer of institutions that gets built that then produces what looks like a very stable unit of exchange and of account. And, you have a different set of institutions in a different configuration during the Bretton Woods era, even though, again, in theory, gold is still at the bottom of it. And it's that key building block whose properties have not changed. And so the way that we think about Ample is, DeFi right now is building a set of institutions. And Bitcoin and hopefully Ampleforth can be building blocks in this at the bottom, right? So you could set up a lending protocol that takes in Bitcoin and Ampleforth, right, as collateral. And so for the depositors, perhaps they get some of the rebase benefits if it appreciates. You then issue, a coin on top of that sort of pool of collateral. And, that might be the thing that gets you closer to a stable unit of account without a link to the dollar or something of the sort. But yeah. I think oftentimes there's an ambition in crypto to kind of take the whole stack and vertically integrate it into like a single protocol. And I think that was what some folks also thought Bitcoin would do, right? It would be the base money and as well as the output. But in reality, you do need a set of intermediating institutions. And I think, this summer, has seen the construction of a lot of them. So.
Yeah, I would add one more thing, which is like, there is kind of this function of precious metals that's well understood and economically valuable, even if it isn't the base money for a stable currency, right? So we don't, like, gold today isn't really being used as a base money, but I mean, precious metals have historically been thought of as a kind of a check against inflation, not like other kind of equity assets and stuff like that, but also as a check against boom and bust cycles. And so that's another one of, the opportunities I see with Bitcoin, which is that, because it doesn't have a direct connection to traditional indicators of consumption and production, it can act as a check against boom bust cycles and a check against inflation. And that's really quite special because everything else is much more closely connected. And that is a big deal. So even if, this ecosystem, a new financial ecosystem is not created on top of things like Bitcoin, it still serves that, traditional function of what a precious metal would serve, which is really big. And in the past, there have been many precious metals, not just one. It just kind of seems like ever since Bitcoin, all the assets that have been produced have moved just like Bitcoin. So it's almost like we do have gold, and we have gold nuggets and gold bars and just more and more variations of gold, as opposed to gold and silver and copper, right? Which collectively could be a check against boom bust cycles and inflation. And so, it does have that quality too. So really, from my perspective, that adds more incremental value to the macroeconomic ecosystem than something that is identical to the dollar, because we already have dollars. I kind of tend to think, as though we're all in one kind of, perhaps two interconnected global economy, as opposed to these kind of siloed systems that, exist in a vacuum. So I'm not sure if this is helping, but I mean, I think we might make some of those changes you suggested if, we were convinced that it was better, to be more stable, right? All told, as opposed to, just have the Ample receive this 24-hour volume weighted average price exchange rate as a proxy for whether there's more demand than supply, and ease into the increases of supply, as opposed to necessarily correcting any price deviation as quickly as possible. I mean, I think it's it is too easy to assume that that is the goal. And when we examine it a bit more, it's not clear that that adds as much kind of value to the broader ecosystem. Maybe Manny can speak to this, or Brandon.
Yeah, so I think there's the short-term view of sort of unit account, long-term view of unit account. Yeah, I think as long as we set the directions correctly, things are generally going to go where it's going to go. I think that was more of our concern now, especially in the early days. Even if you wanted to compare this directly to fiat, which is sort of, I think, the perspective you're coming from, I think it's interesting to look at where a lot of the stability of fiat comes from. Manny probably knows more about this on the economic side than I do. But if the supply of the US dollar changed dramatically, today, it might be a long time before prices actually change, in the real world, right?
Oh yeah,
so
we're lightning fast.
So.
We're incredibly fast by comparison to central bank movement.
Yeah, I mean, a lot of the stability from fiat comes from the nominal rigidity you get from denominating goods and services and debt and contracts through time, right? And wages too. Like wages have very strong, rigidity around those. And so, you want the stability to come, organically from sort of usage of the asset within the economy, or do you want to sort of force it by having sort of peg that you have to defend and spend money from some sort of reserve? So I think, our perspective, we're taking a much more long-term view over the notion of stability and the notion of this unit account.
Yeah. I mean, I think it gets really, really simple if you start to just kind of draw a line between thinking in terms of replacing a central bank versus kind of expanding the function of a commodity money, right? Because it's really straightforward to see what is the function of commodity monies today and how might they be improved, right? So these commodity monies, they're check against inflation, boom bust cycles, and they've historically been used as building blocks for financial ecosystems. What limitations do they run into as building blocks? Well, supply inelasticity. So if we add elasticity to it, might be better served as a building block, but that doesn't forfeit its potential position to occupy as like a check against inflation, boom bust cycles, which is tremendously valuable. If we start to engage in a discussion about like what's wrong with central banking, we run into, it's like the Thanksgiving conversation that never ends. Nobody can really agree because like these central banks have very clear mandates, right? Maintain a certain level of employment, right? Maintain moderate long-term interest rates, like don't let inflation get carried away. And all of these kind of mandates are predicated on a sovereign government being responsible for people, right? So with an independent money, there are no people to govern, and therefore you can't get carried away with like, low interest rates in service of improving employment because there are no people to employ. So at some level, you kind of need to zoom out and ask, like, what is the actual mandate of a government independent money? And the tried and true mandate, as it were, is to be a check against boom and bust cycles and inflation. Now, one way to be a great check against inflation is to be perfectly stable. But that's not the only way. I think that, like, yeah, I really just think looking at it from that perspective, it's like, what are precious metals good for today? How can we improve upon that, as opposed to what's wrong with the dollar today? It really starts to clarify the approach here without minimizing it. In fact, I think it's bigger when you see it that way. Like
we'll open it up for questions in a few minutes. So again, if you've got any questions, feel free to put them in the chat. And we'll bring you up as a panelist if we pick your question. I've got two questions, and one is more a definition, just so I want to make sure I understand, because you've used different terms. So as I'm understanding it, so base money is very broad, and that's and then a subset of base money is commodity money.
A base money. Okay, Manny,
I can take this one. No, this one's easy.
Yes.
So I think base money, I mean, we're thinking about, there's things that are redeemable in something else, and then there are things that are not redeemable in anything, right? And so if you think about, the digital money that exists when you pay with a credit card or on PayPal, in theory, that's supposed to eventually be redeemed in like US dollars. And the US dollar cannot be redeemed for anything. So US dollars, fiat today are base money versus non-base money. So those are the two distinctions. For commodity money, this maybe we should have done the synthetic commodity presentation. So there's a classification that the economist George Selgin did, because he's a historian primarily of free banking and systems that are built in that way. But he was basically trying to draw the properties that differentiate commodity money from fiat money. And so he said that there are two dimensions, right? One is the existence of non-monetary use. So, gold has a non-monetary use, and it can also have a monetary use. You then also have supply. So the supply is absolutely determined or contingent on the discretion of some authority, right? And so commodity money is something that has non-monetary use and has absolute scarcity, right? It's not up to me to decide how much gold there is in the world, and gold is useful outside of a monetary context.
Short.
Yeah. Sorry?
I said, don't sell yourself short.
Well, we'll find. Well, if you do invent nuclear fusion, you could change the supply of gold. But outside of that, it's very difficult. And then fiat has no non-monetary use, but its supply is up to discretion of individuals. And then Bitcoin was this strange hybrid that so you can think of this quadrant, this 2x2 sort of graph, and commodity money and fiat money take up 2 spots. You still have 2 empty spots, right? So Bitcoin filled in one of the empty spots, which was something where the supply was absolutely determined with no discretion, but it has no non-monetary use. And Ampleforth sort of fits in there as well, right? So the supply is not fixed. Fixed supply is the easiest absolute scarcity, but you can also have rules determined kind of supply, where it's not up to us to dictate what supply is. It's determined by the world. So I hope that clarifies, I think, some of the definitions there.
No, definitely helpful. And so, and just continuing on with just the commodity, and then one last question after this. Mm-hmm. So, is it you talk about gold, and is one analogy to think about Bitcoin as as gold and Ampleforth as silver? Is that?
Yes. So you could. Historically, the supply of silver has been more volatile, but it still produces the same problems. So in 1935, the Chinese government went from a commodity-based system to fiat because the United States was messing up silver supply production, because the senators from those states had a lot of influence and they wanted to restrict the supply, and it led to all these problems. So it still opens you up to the same kind of vulnerabilities. I would say Litecoin is more like silver than. Ampleforth is unique in the sense that people have theorized about this since the 1960s. Like James Buchanan, who's a Nobel Prize winning economist, kept writing about a type of money where the supply would adjust based on demand, right? And he posited that if we could only have a giant supercomputer that we could set up to manage the accounts of everybody in the bank, and increase and decrease the supply of money, and then destroy the password so no one could change it, then we would have this perfect money. And it just took half a century to build, but I think that's where we are now. So I wouldn't compare it to silver. I don't think it has a natural analogy, because there's nothing in the natural world that has this kind of property.
Okay, that's very helpful. The last question, then we'll open it up. We've got a few questions already lined up. Is can you discuss Geyser and how that's gone, and what you've learned from that experience?
Brandon, why don't you take that one?
Sure, happy to. Yeah, so Geyser is the program that we launched at the end of June this summer. We call it our liquidity mining program. So there are 2 goals of this when we set out to develop it. One was we wanted a sort of open participation model for distribution, right? So we need some way of getting Amples out into the world. And we wanted to do so in a way where it was permissionless, and also in a way that helped the overall health of the ecosystem. So what this does is it provides an ample reward to people who provide on-chain liquidity for Ample itself, right? So since Ample is a sort of base money monetary asset, having more liquidity for Ample also increases the sort of base value of Ample itself. So that was that was our goal. And that's what we wanted to incentivize. And so it's been very successful so far. I think Evan did post a few statistics in the previous slides. And I think, this kickstarted a couple months of very explosive growth. And I think one of the reasons for that is that the launch of the Geyser program created a defined event where lots of people could, at the same time come and look at the project and also see other people looking at the project to give them confidence to sort of act, right? So while Ample has been live for over a year, I think we really needed this sort of kindling to get it started, right? So a lot of value comes from a shared understanding of value. And so I think that was sort of the kickstarting event that sort of got us to where we are today. And then the Geyser itself is also, since we call it liquidity mining, we think of it similar to Bitcoin's proof of work mining. So Bitcoin's method of distribution is to provide Coinbase rewards to people who run nodes and do proof of work mining that supports the system itself. But since Ample is not a layer 1 blockchain itself, we're built on top of blockchains, which is itself another sort of design characteristic that we haven't really touched on yet. Our method of Bitcoin's proof of work is sort of proof of liquidity. So that's, I think, a high level of how we think of the Geyser programs. And we also view this as a long-term program too. So in the same way that Bitcoin's emission curve goes out over years, the Geyser we've committed to, as a 10-year program going forward.
Okay, thanks, Brandon. So we'll take our first question from the audience. And now, so you've been promoted, Chris, to a panelist. Chris, you up for your asking your question? You got to unmute yourself. Chris, if you want to ask the question.
Oh, sure. Actually, my question was about how you kind of are viewing the DeFi space in terms of these anonymous founders and things like Base, and kind of like how you guys are grasping with like the anti-VC sentiment, which I think is like kind of unfair. And secondarily, how are you guys viewing kind of the quote unquote degen fast money, and being a base money in all these like sushi swap and things like that?
Yeah, I mean, I can take at least part of that. Yeah, there is kind of this anti-VC sentiment, and I do agree that it's a bit unfair, but I understand where it's coming from. It does kind of denote this sense of privilege, right? Where like certain people have access to an early stage asset class and they reap huge benefits from it. Like, for example, like if you were the first money into Uber, well, you probably had to know somebody, right? It wasn't the case that all money was created equal. It's like money and connections, money and long-term value alignment. It's all about like, how they can help you beyond just the dollar that they give you. Those are the folks that are able to get into those early stage deals, and then they become larger stakeholders and they experience a great deal of kind of wealth appreciation as a result. And some folks can feel as though that's unfair. But I would say, like, I don't really like indexing on fairness at all, because like it's not, in the case of like early stage farmers, it's not exactly fair either, right? So you need to have assets in order to stake and kind of farm tokens in general. And it's the case that whoever has the most money is going to be able to create the largest position through a farming kind of initiative. And
sure, I mean, capital.
Yeah. So it's even, it just kind of becomes the type of situation where the people with the most money will have the most power, except for in an even more free market way. So what I would say is not being captured here is the fact that like folks who don't have money or information or privilege are not being encouraged or allowed to participate in these systems at all. And so that's where I would kind of shy away from calling anything fair. Because like in a more fair system, like you wouldn't have to have the most money in order to farm the most based money, right? Or yam,
actually,
right?
Sure, a little bit interesting too, because the distribution of base was based on wallets being limited to a certain amount, but you can look on the blockchain and see that there's like a few wallets that, mine the maximum amounts.
Yeah, it's going to naturally regress into a power law distribution when you open up a system. That's why we have kind of, not a direct democracy, but kind of a representative democracy with this voting system. I think that in general, if you're saying that it's more fair to just let people with the biggest stacks also have the most control, then I would just kind of disagree with that. In our case, I don't want to index on fair versus unfair. The fairness in our system exists in a different dimension altogether, and that comes from the fact that it's truly non-dilutive. So there is no extractive kind of component here. There's no fee token. There's no profits derived from the minting of coins or seigniorage that's being captured in a reserve or by any third party. It's kind of just being, delivered to the people directly.
I would say some of the anti-VC sentiment comes from the experience of the 2017 ICO boom, where a lot of not a lot, but some VCs would definitely, get early shares of tokens and then would quote unquote dump on retail, right? I think most projects now that are VC funded have sort of vesting schedules, lockup periods where, basically that behavior does not happen. And that's because of the legal structure of the investment. And these anonymous founders, as Chef Nomi, I mean, he basically is replicating the bad behavior of 2017, and yield farmers in some ways are totally free to do that as well, right? They're totally free to deploy massive amounts of capital, farm, and then dump the token while hyping it up somewhere else. So I would say in some ways the solutions that people are proposing are basically the solutions that have existed in venture capital. I just think people forgot about these in 2017, and now we're in this weird paradox. But I would say to your other question about DeFi composability, I mean, I think it's fantastic. I think Ampleforth can be integrated easily into a lot of smart contracts without people trying to, replicate the effect that Ample already incorporates through its system of oracles and rebasing. Sorry, Brandon, go ahead.
Oh, I was just going to say that, the problem with the word fair is that it means something slightly different to everyone, right? And so for a lot of people, like a lot of what you would call degen farmers, sort of unfair that people had access before then. But for everyone else, they would say, oh, it's kind of unfair that all these degen farmers got access before me, right? So Yam, when they're doing their migration from the one that was, obviously kind of rushed to market in 10 days with not even a single unit test, right? And they're sort of saving these people on the next system. Like, is that encouraging sort of bad behavior for the future? Again, it's hard to really say, right? Is that itself fair? Like maybe it's fair to the people who are involved for sure. But is it unfair to everyone else who said, oh, the system is entirely unsafe, as was very obvious to anyone looking,
I think it's just
to work around.
Yeah, I think it's just dangerous to call yourself fair or unfair in a free market system like this, because we're really just, it's pretty hands off. The market will reallocate in organic ways that are beyond our control, and it might favor wealthy people or risk takers, but it certainly isn't going to redistribute wealth to those who don't have it. And like you said, Brandon, fair is defined differently for different people. But I can also take that comment about being wrapped up in the degen DeFi space, because I do want to comment that, like, it is true that when Ampleforth launched the Geyser, a profound amount of wealth was created in a very short amount of time. And suddenly a lot of other projects are copying systems for that reason. But the reason I don't like being wrapped up in the degen DeFi space is because we actually have a real kind of economic theory that we're testing here that's long-standing. It's like Manny said, it dates back to Buchanan, right? So we have questions that we want to answer, and we're primarily a research organization. We've been at it for a long time, and our motivation for entering the space is actually fairly different from the motivations of people who are just copying a hyper growth mechanic and applying it without running unit tests and distributing it as quickly as possible. You can kind of see from the history and actions of folks like what their intentions are. And I hope that our actions kind of, speak for themselves as well. We didn't raise a lot of money from VC. We raised $3 million. We did a single seed round. We weren't like one of those like massive, like $1 billion fundraisers.
No, I don't have that opinion of you guys at all. And I think that these and alignments like make sense compared to a lot of like the fast farming, high inflation type things. I think eventually the LP model might switch to more of a VC type model where you're locked up longer, where it's something like you guys have, where the longer you're providing liquidity, you get an increase. I think that's a smart idea.
Cool. Yeah, we appreciate that. Those are good questions.
I love
Good
the
questions.
project. I just had one more question, which was, as you see all these like new types of blockchains, Solana and Algo and the Binance chain, how do the integrations with that work?
Yeah.
Yeah, so
There, because you can't really
Oh, he dropped off.
Go for it, Brandon.
sure, yeah. Yeah, so the idea of Ample existing on multiple layer one platforms is something that I would say has been core to our DNA since the beginning, right? So our first blog post on this topic was over a year and a half ago. So we've been thinking about this for a long time. And very early on in the project, we made the explicit design decision to not build our own blockchain, right? And the thinking there was that instead of creating our own silo and asking people to come to us, we would rather just be where people already are, right? Making transactions, storing value, building these sort of applications that would become the future of what we call DeFi now. And so I think that was sort of a directional decision that we made early on. And also Ample, because it's not tied to a particular blockchain, it means it can exist on multiple blockchains simultaneously, right? So the main modules of the system is that we have a supply policy and an oracle that takes information from the market and then makes a decision about how to adjust the supply. Then there's the token itself that people use to make transactions with. And so if you want to take Polkadot as an example, we could have Ample exist on both Ethereum and Polkadot by deploying the contract onto Polkadot. And then as long as there's a bridge that allows two operations, then it's essentially the same currency, no matter where you are. So as long as I can transfer Ample from Ethereum to Polkadot and back, and then as long as I can make a one-way function call for this rebase, the supply change from the Ethereum supply policy to both the Ethereum token and the Polkadot token, then Ample on Polkadot and Ethereum, it's the same currency, right? Because it shares the same pool of liquidity and the same supply policy. And so that's sort of our vision, right? Is that Ample can be blockchain independent, right? So if you're dealing with DeFi on Ethereum, ETH has a lot of direct use. If you're on Polkadot, ETH has a little less use, right? But DOT has a lot more use. But if you had a blockchain independent monetary asset, then this could be something that could be the same anywhere and be a sort of highway of value or a main thoroughfare of transfers, no matter what ecosystem you're part of.
Yeah, just kind of dialing it back to kind of what Manny was saying earlier, like economists have classically kind of looked at monies in terms of scarcity and use value, right? Things like ETH have a use value that's native to the Ethereum ecosystem, and DOTs do as well to their ecosystem. A pure monetary asset that kind of exists and is absolutely scarce across multiple chains is a money. There's no reason to believe that money should be connected to any specific chain. And I think that's a kind of a natural misconception as well, that the money and a chain are connected. That's like kind of saying gold is only gold if it comes from this one mine in Venezuela, not like, if it comes from any mine.
This also makes me think of the Union Square Ventures, remember the thin protocol, fat protocol thesis, but now it seems like it's just going to be protocols on top of protocols on top of protocols. So we'll see how fat the value accrual, happens. And I think being blockchain agnostic or, which are themselves protocols is actually quite an interesting experiment, I think, for that thesis.
Yeah. Do we have a time for another question?
Yeah, we're at the top of the hour. Unfortunately, we were only able to get to one question, but Ganesh, thanks a lot for co-hosting today. Evan, Brandon, Manny, thanks a lot. You guys were awesome. Thanks to everybody who dialed in, and we'll see you next week on Stablecoins Are Killing It, episode 15. Bye, guys.
All right. Cheers.
Bye, guys.
Thanks.